Hi everyone, good afternoon. We'll be kicking off this webinar within the next couple of minutes. Before that, I would like to confirm if you can see the presentation and the presentation only and can hear my voice appropriately. Just write your answers in the questions or in the chat section for confirmation, please. Just confirming again, can everybody hear me fine? Okay, beautiful. Thanks for the confirmation. I'm just letting last few people connect and then we'll kick this off. Meanwhile, what I will do, I'll just go through the disclaimer quickly. Contents of this material are provided by third party, not hot forex, and are for informational purposes only and do not constitute investment advice. Hot forex and blue sky binary assume no responsibility for any potential errors, inaccuracies, or omissions in this material. Nothing in this communication contains or should be considered as containing an investment advice or an investment recommendation or a solicitation for the purpose of purchase or sale of any financial instrument. Any views or opinions presented within this material are solely those of the author and do not necessarily represent those of Hot Forex unless otherwise specifically stated. Currency trading may not be suitable for all investors as it carries a high degree of risk to your capital. Trading such products is risky and you may lose all of your investment. Past performance is not indicative of future results. Poor fill rates, expiry times, market volatility, and platform errors could result in losing trades. Before deciding to invest in currencies, you should carefully consider your investment objectives, level of experience, and risk appetite. You should be aware of all the risks associated with foreign exchange and currency trading and seek advice from an independent financial advisor if necessary. So with this out of the way and everybody connected, thank you once again for attending today's webinar. Today we'll be discussing the RSI, the Relative Strength Index. So does this work? And if it does, then how to use it? This webinar is suitable for mainly beginners who haven't really explored the technical aspects of RSI and are looking forward to get a brief introduction to the indicator. So we'll talk quickly just a little about us. We'll reintroduce myself. What is the RSI? Does it actually work? How to use it? How to manage your risks when using the RSI? And of course, as per standard, we'll discuss the dangers about FX trading, and at the end we'll have a Q&A. So if you have any questions during the webinar, perhaps you can write them down and ask at the very end of the webinar. I'll do my very best to answer them. So I am one of the senior traders in Blue Sky Forex, which is a part of Blue Sky Binary. We are an education and research trading group. We'll provide 24-hour trade support and analysis to allow all traders to trade safer. Blue Sky Forex is presenting this webinar on behalf of Hot Forex in order to educate you and help you become highly profitable currency traders. So the two types of markets that you will come across when doing your daily trading is a trending market and a mean reversion market. Trending market is essentially more powerful because generally speaking it is fueled by significant news that is driving the price in the certain direction. You may most likely have heard the phrase trend is your friend, which is generally true. Mean reversion, aka ranging market, it is more common, however also a bit easier to identify. and definitely can be profitable, no matter what approach you are taking towards trading. The RSI indicator itself is more commonly used during the mean reversion mean reversion trading, sorry, and then try to identify the very peaks of the price movements by taking a look at the overbought and oversold levels and what the RSI is indicating, and just trading against the direction of the trend. So what is RSI? It's a technical momentum indicator, and it is created to identify the likelihood of reversals. Welles Welder is the creator of this indicator. He's also the creator of the parabolic SAR indicator that we're not going to discuss today, but can definitely be looked into, because it is another technical indicator that can be also used in conjunction with the RSI. So what RSI does is it measures the speed and the change of the price movements, essentially average gains and average losses. There is a formula, you can look it up on the web. Generally speaking, it's said that the price is overbought when the RSI indicates a value of over 70, and the price is oversold when the RSI value indicates lower than 30. So relatively straightforward. The minimum is 0 and the maximum is 100 on the RSI scale. Now, the idea behind the visual observation of RSI is relatively easy. You can see at the lower part of the picture on the left, this is the RSI value, and essentially it goes up and down. It indicates whether the price is overbought above the 70, and if the price is oversold above below the 30. However, taking this simple concept and trading just based on the overbought and oversold values of 70 and 30, this strategy really it will not be successful long term. It might work out really well a couple of times, but the price can be trending in a certain direction for a very long time, and the RSI in this occasion can also be over 70 or below 30 for an extensive amount of time. So definitely don't apply this simple logic of going short when the RSI indicates overbought, or going long when the RSI indicates oversold. This simply doesn't work. Okay? But does the RSI work at all? Yes and no. I will explain. If one looks to identify divergences, midline crossovers of the RSI, and so-called failed swings, then using the RSI simply alone can actually provide you relatively decent trade opportunities. Yes. However, the RSI is based on lagging data. That means you should really be careful when using this indicator in overall. If there are major news released on the market, then the RSI can go to either extremity really quickly. And when you decide to use this indicator, definitely try to stay out of the market when the big news are released, because the indicator itself loses its usefulness quite quickly. Okay, so wait until the price has calmed down, and then start searching for additional trading opportunities. So the divergences, midline crossovers, and so-called failed swings with the RSI indicator. Let's take a look at these. So the divergences, this is a topic also generally discussed in another webinar, divergences between indicators. But in case of RSI, the example is in front of you. So a divergence between the price and the RSI values, this is something you should be looking out for. The very common period for the RSI indicator is 14. This is quite widely used, although to me personally 14 is a bit choppy. So of course, depending on the occasion, sometimes raise it to 21. Yeah, I do like RSI period of 21 instead of 14. So let's discuss about the divergences between the price and the RSI. As you can see that the price is reaching higher highs on the left side here, that is indicated with this black line. But on the RSI, you see that we have lower highs. Okay, so you can see that the RSI is moving lower. The high points at the peaks are moving lower than the very earlier peak. That's completely opposite from what the price is showing us. And this divergence between the price and the indicator is hinting of an upcoming reversal. As on this example, you see a major reversal happening after the divergence in the price and the indicator. And same goes for the right side of this picture. You see that the price is actually reaching lower lows. However, the RSI is showing something different. So it's really clearly visible how the peaks are in the other direction. And this again indicates or hints about a reversal coming up. And the price is losing momentum. And this is what the RSI is showing. And we have a major reversal happening after that divergence. Okay, fairly straightforward. Definitely, it's relatively easy to identify as well. That is a big plus about divergences. They are relatively easy to identify if you have an eye for it. Of course, developing an eye for identifying these divergences and every values and how to say formations of technical indicators and price takes time. It takes time to develop a good technical eye for the analysis. The next thing is midline crossovers. Now, I personally don't really favor this method, at least on any chart time frame that is below daily charts. If you open up daily charts and above, then these midline crossovers would actually work a bit better, because after the midline crossover has happened and the candle has closed, you can attempt to trade the next candle. If you go with 30-minute or 15-minute chart, then the magnitude of the next candle is relatively small, and you might be looking into perhaps around 5 pips gain only. And in terms of risk reward, it doesn't really look logical, right? So for these midline crossovers, definitely use a higher time frame chart, because then you can actually make a decent pip profit from these crossovers. Now, I don't personally like this method, as I said before, because during really choppy markets, you have the RSI lingering around the very 50 level quite often and quite a lot. So you have a lot of action at this level, so it's really difficult to identify when the actual opportunity arises. Okay, so I feel this a bit dangerous, at least during choppy markets. If you have a decent trending market, if you see the price relatively steadily going in one direction, then keeping an eye out when the RSI crosses the midline, and then going with the trend, this might work out pretty nicely. But if you see any choppiness on the market, then I would suggest not to use this midline crossover method with the RSI. Okay, Anissa is already having one question. Don't worry, I will answer it at the end of the webinar during the Q&A section. Right, now, failed swings. This is an interesting one because this quite often, if you know how to identify the actual and the right opportunity and the right formation for this, it can prove really useful. So, what is a failed swing? On this occasion, we're dealing with a bullish failure swing. So what happens here is we're looking at the RSI. When the RSI touches or pierces slightly the 30 level, which is our oversold level. So if you can see the mouse, you see the RSI moving just slightly lower than the 30. It then bounces back to around 40 level, okay? And then retraces the just slightly above the oversold level again, just slightly above 30, and then goes back to our previous how to say, our previous sort of say bounce, right? So at this red line here, this is level 40, and as soon as the RSI reaches back to this level, you can go long. Okay, this is a failed swing. So once again, the price or the RSI dips down to 30 level, pierces it slightly, bounces off, goes back to 40, retraces again to near 30, does not pierce it, of course, it needs to stay just slightly above 30. And as soon as the price reaches again 40, it will form this kind of a W at the oversold level of 30, right? So this would be your entry point, if you can see the mouse. Okay, just the breakout sign. This would be your entry. Just go long, and on this occasion you would have reaped relatively decent profits. I'll try to find some examples on the live chart later on, just to see if you can identify a couple of these opportunities from the price history. So let's go into MetaTrader 4 right now. You should be seeing it popping up in a moment. I believe everybody now sees the MetaTrader 4. Now again, this is a 1 hour Euro USD chart. Everybody who has been to my webinars knows that I like Euro USD and 1 hour charts just for finding some examples for you. This is the current moment. This is an open candle. Just to let you know, just to show you that we're dealing with appropriate live data feed. Now, how to add the RSI onto your charts? It's really easy. You go to Insert at the top left. Then you go to Indicators. You find the Oscillators category, and you open up the Relative Strength Index. So now this window pops up where you can specify some parameters. The common period for the RSI is 14. You apply it to close. You can set the color here, really easy, straightforward. The width of the RSI itself. And don't touch these. at least in the beginning. Don't need to touch these, the fixed minimum and maximum. Now, if you go to the levels tab, this is important. You can set different levels that are drawn onto the RSI. To bring these examples to you, I will add level 30, which is our oversold level. I will add 50, which is our midline in the RSI, and I will add 70, which is our overbought level. Okay. You can, of course, adjust these to your own preference later on after you have gotten used to using RSI and develop a certain strategy that uses different levels. That's totally fine. But here is where you do it. Okay. So we click OK. Our RSI appears at the bottom of the chart. So the very first, before this webinar, I just take a quick peek on the Euro USD chart here already, and I noticed an immediate divergence in the price and in the RSI value. So let me show you. These are the 2 or 3 peaks of the RSI. They show you that the price is losing its momentum, but the price itself is actually going higher and reaching higher highs. Okay, so you see the major difference in the price and what the RSI shows you. So this is called the divergence. And at this point, somewhere here, you could already look for a trade opportunity. You could realize that no, the divergence is happening between the price and the RSI. It might be wise to go short. Now, if the price attempted to retrace the previous high, it didn't really get there. Maybe somewhere in the middle of the candle here, or at the end of the next bearish candle, you could have gone short. And I'm sincerely hoping that just to check the future outcome of this example, the price actually does drop to around, let's see where it actually can go. Most likely somewhere here to test this level here, or this level. So most likely price will reach somewhere here. This could be your take profit, and this could be your stop loss, the previous high. Okay, so a perfect example of a divergence forming. So really interested in seeing how this plays out. You can also keep this in mind and check out how this actually does play out just after a couple of days. Right, so let's take a further look into the previous price history. Let's check. What do we see here and what do we have? Okay, one thing about the mid crossovers that I mentioned before, and why I don't like to use them, is that we have a relatively ranging moment here of the price. As you can see, the price quite often moves back and forth from the midline, and on this occasion it moves back and forth like 3 times. So when should you trade these? Well, there's really no definite answer, because neither of these trades would have really played out, right? So yeah, I don't like these midline crossovers too much. Now, if we zoomed out to a daily chart, then you can see you have a lot fewer of these midline crossovers, and not so bulked together. Okay, well, on this occasion you have them a bit more often, because we're dealing with a ranging market here. But there are much more rare, and you can actually trade these a bit better. Okay. Let's get back to the 1 hour chart. Let's try to identify a few of these failed swings formations. Okay, let's see if we can find any. And I believe this to be a bit more difficult to analyze, more difficult to identify. As you can see, at the top line here is 70, bottom line here is 30, and the midline here is 50. Okay. 1 second. Let's scroll back a bit further. Let's see if we can identify appropriate failed swing formation. Here you can see that these formations do not happen too often. Okay, this looks a bit similar to the failed swing formation. However, the bounce should be at level 40, but here on this occasion we have only 34. So this bounce is not really big enough for it to serve as the failed swing formation. Although the next retracement or the next touch of the RSI is directly above 30 and the previous peak is directly below 30. So in terms of these points, the formation would be valid, but the bounce is not large enough. If the bounce would be up here at level 40, then you would be trading long at the same level when it goes back up. And you could have profited from this large movement up here, this candle. Okay, it's quite significant candle in terms of pips. It's around 40 pips here, but this is still not a completely valid formation for this. So let's look further a bit into the past. Perhaps we can identify. Here we go. We have another divergence between the price and the RSI. Let me show you. We have a peak here going here, right? You see it going upwards. However, the RSI tells you another story. It actually goes downwards, so it's losing momentum. And trading after this bearish candle here, you could have won this trade easily in going downwards from here. Okay, so another example of a divergence between the RSI and the price. These divergences are most easy to identify within the RSI and in the price. So I would say that the divergence from these three formations or three concepts is the most easy one to use. Okay, let's go further. Let's see. Failed swings just have very specific conditions they need to meet for it to be a valid formation, right? So okay, that doesn't work because the failed swing is still at 34, not 40 as we need it to be. So again, not a valid formation, although it would have worked out really nicely. But that's not the point. Let's see if we can find any of these formations. Interesting. Again, not a valid formation. The failed swing is not high enough. We'll need to find at least one. Okay, this already shows that I have not in-depth analyzed the price history before the webinar just to bring out the best examples for you. I'm just going with my visual technical observation capabilities to find the formations for you. Okay. If you just analyze the RSI with me, if you notice any of these formations, don't hesitate to let me know if maybe I miss a couple of opportunities. This looks like almost filling the conditions of the failed swing formation. It goes a bit further past 70 with the first peak. It goes almost to 60, which is meeting one of these conditions, although the next peak should be just a bit lower than 70. On this occasion it's 72. So if you want to be really precise with the conditions, this would not qualify as a failed swing. However, if you did trade this, again, you would have won quite good. This is a relatively good move to be short on, right? Let's look a bit further into the past and see if we can actually get a proper failed swing formation. Okay. Seems these don't happen really often, and to be honest, I personally haven't traded these either, because the conditions for the failed swings, they are so precise and quite difficult to meet in most cases. So that is the reason why we're not really finding any of these at the moment. Actually, let me see. This might be meeting the conditions almost. Okay, again, the failed swing is not strong enough. It doesn't really go back to 40. It stays at 35, 36 at this point. Although in terms of these two peaks, the conditions would be met, and you could go long here, but as you can see, it would not really have played out really well. Price starts to range here. Might have hit your stop loss somewhere around here or here. But after this consolidation of the price, you did have a really strong move upwards. So it might have worked out for you, might have not. It's all up to the stop loss and take profit levels you have assigned. Anyways, I'm quite sure you have gotten the idea of the conditions of the failed swings, as these conditions are really precise. It's not too easy to find the actual setups based on these conditions, but if you notice these can really help you identify a good trade opportunity. Okay, we have another divergence here as well, which is really easy to identify. We have tops forming higher here, but here we have tops forming lower. So you can see the divergence between RSI and the price, and again price reversal after this this upwards move. Really straightforward. Okay. So don't worry, I'll answer all the questions at the end of the webinar. Let's get back to the slideshow. One sec. Okay, back to the slideshow. You should all be seeing the slideshow at the moment. So let's talk about managing risk when using the RSI. It might answer some of your questions. Now, as I like to say always, that setting your stop loss and take profit levels, it completely depends on your personal trading style, your risk appetite, your trading targets and goals, and your strategy. The first three being the most important. Now, you always have to have a decent strategy to trade, no matter what indicator you're using, or if you're using only the price action, only the price or candlestick analysis. You still have to have a strategy. That does not mean that the strategy does not mean that certain indicator conditions have to be met and then you will enter the trade. Strategy means it means more. It means you're incorporating your trading habits, incorporating when you are trading, the trading hours, the trading sessions, the indicators you are using, and when. Being able to analyze the support and resistance levels, being able to identify when to stay out of the market, when to look for trading opportunities, all these things incorporated and more things that I didn't mention result as having a trading strategy, right? It's not simply based on certain indicator conditions. That's not a strategy. Okay, strategy is something much more. And developing a decent trading strategy requires a lot of work, not just analyzing technical indicators. Okay, so keep that in mind. Now, in terms of risk or reward risk ratio, risk reward ratio, doesn't matter what way you put it. On this slide, we're talking about the reward risk ratio. So if you are a beginner, if you want to tackle the markets and you are relatively new to it, then aiming for reward risk ratio 1-to-1. So that means your take profit and stop loss levels are equal in terms of pips. Okay. If you get a bit more used to trading, if you gain more knowledge, then raising your reward risk ratio to, for example, 2-to-1 is a next good target. That means having your take profit level 2 times the stop loss level in terms of pips is a good thing. Is inadequate. Of course, later on, by raising your reward risk ratio even further, can enhance your pippage gains, but be really careful. It does require a lot of practice. Now, martingale and dollar cost averaging. Try to keep away from martingale. It's really dangerous, and you can blow your account within minutes because the market can move in one direction for a longer term, then you can remain solvent. Martingale is essentially doubling up your position on the same trade opportunity. Dollar cost averaging, on the other hand, is a bit of a different approach to martingale. It's not martingale per se. It's a bit similar in concept. Okay, now let me explain. If your standard trade size would be 1 lot, okay, that's what you usually trade with. Then when you apply dollar cost averaging, then you will not only initiate 1 trade per trading opportunity, but you will initiate, let's say, 3 trades. So let's say you go short on Euro USD. It doesn't matter of the asset, does not matter of the price. You go short. Instead of initiating 1 trade with lot size of 1, you initiate first short trade of 0.3 lots. Okay. Now, if the price moves against your desired direction, then let's say after 10 pips, you initiate a second trade again with 0.3 lot size. So now you have 2 trades on the same asset in the same direction, but the second trade is with a better price. Now, if the price again moves against your desired direction, you initiate the third trade with a lot size of 0.4. again after 10 pips of price difference. So this results in the same standard lot size of 1, but you have spread out the risk in terms of your entry levels. So each and every trade is with a better entry level. Okay, this is called dollar cost averaging. And if your trade accuracy is around 50 or lower, or even up to 60, then dollar cost averaging can be really useful concept to use. If your trade accuracy is extremely high, 75 plus, then dollar cost averaging can still be used, but it would render your gains be ultimately a bit lower than you would have if you only entered one standard trade like you usually do with lot size of 1. Okay, so keep that in mind. For lower accuracy, use dollar cost averaging. If you have high trade accuracy, you might want to skip it. Okay. Now, trading stops. Trading stops is something that I recommend using when you are position trading longer term, because the trading stop can be really useful tool if you use it right. When you are scalping, then it wouldn't really make much sense using the trading stop, because the price fluctuations are relatively strong intraday. So your trailing stop can easily be triggered by one spike in price. Okay, but if you are longer term trading and aim for these large pippage gains, then setting trading stop for around 30, 40, 50 pips would make sense. Okay, because 50, 40 pips is not your standard intraday price spike. Okay, so that would be useful. And definitely keep in mind the support and resistance levels when you're using trading stops. Okay, I mean, support resistance levels are a very important part of daily trading, so you always need to be able to analyze and pinpoint those. Okay, let's talk about currency trading dangers as per standard. Most of the bots, 99% of them, are scams. They are driven by affiliate marketers who don't know what trading means and just put together some random conditions and put them into in a form of code that automatically initiates trades in behalf of you. Now, these are not designed to earn you money. These are designed to empty your wallet, and that's it. That's straightforward. So if you want to use a trading bot, aka an expert advisor inside MetaTrader 4, then definitely do sufficient background checks. Use it on a demo account first. Really important. Don't attach any bots or any programs to a live account from the start. It's common sense. Use a demo account at first. It doesn't take much to set up a quick demo account and test out an expert advisor there. Now, quite a low percent of traders actually earn money in FX trading on long term. As difficult it is to accept, trading actually is something that requires practice, concentration, especially emotion control, and of course money management. So learning all these key aspects of trading takes time. You can't be a professional trader earning $10 or $1,000 a day just out of the bat, right? That doesn't work that way. Practice, practice, practice. It's completely okay if you empty one or two accounts. I mean, that is the part of learning. I'm sure most of the professional traders have gone through that period of blowing one or two accounts. I mean, if that happens, take that as a lesson. That means that you should change something. Either you have to develop more, have to develop a better emotion control, better money management scheme, and definitely your trading habits. Try a different market session. If you were previously trading during the US session, then of course switching to the Asian session might prove a bit difficult because you don't want to stay up for too long. But whatever time suits you, just try to switch it or try to change it a bit, because the market behaves completely differently during different times of day. So something to keep in mind. If your strategy doesn't work during the London session, then try it out during the US session when the market is a bit slower and more calm. Okay, so try to test out these different market sessions and then see how the prices or the market behaves, and eventually developing a certain time frame during the day when you are trading and stick to those hours. 5, quite a low percentage of signal services and signal rooms and trading communities are legitimate. So do background checks, ask for a performance record and audit trail if you decide to use the signal from a certain signal service. I would highly recommend engaging in trading communities though, because very often there are a lot of, I wouldn't say perhaps complete professionals, but definitely traders that have been trading for years or for some time, who can provide you with some insight what condition the market is in at the moment, what pairs they are looking at to trade, where they are looking for trade opportunities, etc. And you can also ask them questions. You can also share your ideas, what to trade, and they will provide you feedback whether it is a valid trade setup or a valid idea to trade. So this kind of feedback and these kind of communities can really speed up the learning process. You don't have to trade alone. Okay, there's nothing wrong with engaging other people, other traders over the web to assist with the process. Just seek for knowledge. That's completely okay. It doesn't render you in shame or fear of being labeled as a newbie. Usually, these communities welcome newcomers really well, because I mean we're all aiming for the same goal, right? Being able to trade for profit, being able to fulfill our targets, and becoming highly profitable and successful traders. So, with this common goal in mind, newcomers are usually not rejected. So, really encouraging to engage in these trading communities. Don't hesitate. Okay, so that's it for today's topic. Let me just go through the questions that I have arose. 1 second. Okay. Palanisamy is asking, how do we decide the stop loss and take profit? It's a good question, but as I mentioned before, that the stop loss and take profit levels really do depend on your personal trading preferences and trading styles. If you're scalping, then you're generally aiming for these lower pippage gains. Thus, your stop loss levels would also be reflecting that. Okay, so when you are scalping, that means you're aiming for a really high amount of trades per day, and aiming to reap a really low amount of pips per trade. Okay, so if you're aiming for 15 or 20 pip gain, then your stop loss should also be 15 or 20 pips apart. Now, finding these trading opportunities, that's already a different topic, and then setting your stop loss and take profit levels really depends on what trading opportunity or trade method or strategy do you use. So we can't really set a solid rock conditions where to set your take profit or stop loss. It really requires practice, as with everything. So keep that in mind. Just use a demo account first, right? So set different take profit and stop loss levels based on your trading style and see how it works out. And then adjust as time goes on. Okay. Tendo is asking about the eBay stock in December 2008. Second. Stocks. See. The thing is that year 2008 was a really interesting year, right? Lehman Brothers, market crash. Right, let's go to a daily chart. No, let's go to monthly chart. Right, let's find 2008. Okay, I can't go back that far with an hourly chart. One sec. Okay. So we're talking about December 2008 on the eBay stock, say. Okay, and divergence was bullish. Let me just attach. Okay, let me show you my MetaTrader 4 so you can also see what I'm doing. Okay, we have 2018 December here. Let's see now, what does the RSI show us? Okay, we'll apply period of 14. Okay, levels are right. Let's see what happens here. I think you're talking about this divergence here, right? Okay, you're talking about the Euro USD chart, or are you talking about the eBay stock chart now, Pretendo? Okay, eBay stock. Yeah, I have the eBay stock daily chart open because in 4-hour, 1 hour, and earlier charts, I can't go back to 2008 on the MetaTrader 4 at the moment. So I'm using a daily chart. Okay, so we have the RSI 14. We have a divergence indeed here. But based on this divergence here, I mean, one could have easily profited from going long, right? Divergences, for example. Okay, the example perhaps the divergence, right? As you mentioned. But the example was on Euro USD chart, 1 hour chart that I brought up. You're talking about the eBay stock chart in 2008 December. Indeed, yeah, we have a divergence here, but this divergence, played out relatively well, right? And going a bit further here as well, a bit consolidation, ranging, and then going further up. And this is what I'm saying. Sorry if I didn't answer your question, perhaps, but if I didn't answer your question, then please be a bit more specific. What is your question, and what are we looking at? Meanwhile, I encourage anybody else asking any questions that might have arose. Right, you're talking about the chart on the slideshows. Okay, let's take a look at the slideshows then. One moment. Okay, this is the eBay daily chart. Yeah, 2008 April is what we have here. You're talking about the December time, but do you understand that we're talking about the divergence of this drop here in December, right? Okay, so the peaks here and the RSI showing the other way. But what is there to avoid? The thing is that this divergence here, it actually provides you a relatively decent reversal, right? So this point and this point, somewhere here you would have gone long and you would have won the trade. Of course, I mean, we are dealing with a daily chart here after a month. I mean, this divergence would be irrelevant, I presume. I wouldn't trade this divergence after a month, even if it's on the daily chart. I would look for other opportunities already. So yeah, I mean, this divergence here did provide a decent long opportunity. Okay, I hope that I did provide appropriate explanation to your question. We're hitting the 1 hour mark at the moment. If there are any questions coming in, then now is the last moment, the final moment to ask them. Okay, I see no questions coming in at the moment. Everybody, thank you very much for attending this webinar today. If you have any questions that will pop up later on, then don't hesitate to write an email to webinars@hotforex.com, and they'll do their best to answer it. Okay, from my side, take care and enjoy the rest of your day. Bye.